how to buy a home in Colorado and what is the process of doing that. Now, what I told you here at the bottom of this PowerPoint is, in addition to being a certified instructor at the community college, I'm also a licensed Colorado mortgage loan originator. And because my fear is that if anything I create that looks like it might be used in the mortgage process, there are guidelines and regulations that govern me that state that I have to disclose who I am and that I am licensed. So you'll see at the bottom here, I am a licensed Colorado mortgage loan originator, and this is my loan origination number with the state. And ever since about 2010, which grew out of the great meltdown of the mortgage industry in 2008, there is a national mortgage licensing system. So no one in the country can originate mortgages unless they are licensed and registered with the, we just say NMLS, but you wouldn't have known what those letters meant. So I've spelled it out, National Mortgage Licensing System, and that's my licensing number. And it's one of the good things that did come out of the mortgage meltdown and the Great Recession of 2008. It's created uniformity across the country so that anybody who originates a loan has to be identified. And if they do something wrong on a loan goes bad, maybe because of their fault or not their fault, there is a record of that, and they can monitor to try to make certain that some of the abuses that happened back in 2008 don't happen again. And so the NMLS is a national registry, basically. You have to be able to get certified and licensed by a state, and you have to take a 20-hour mortgage loan originator course and pass a pretty rigorous test in order to get a license. And of course, you have to have a bond and a errors and omission insurance policy to protect the public.
I've been through the mortgage process, but I'm not familiar with the originator terminology.
Okay, so just briefly, tell me about your process, having gone through the mortgage process.
First, I contacted a broker, and then she, of course, runs your credit. And then once you're pre-approved, you get the home you want. Then you go through with underwriting, and they dig a little deeper than just your credit score. Obviously, you're buying a home.
Right.
And then you just sit down and you pretty much sign papers for about 4 hours straight.
Yes, that's true.
Yeah.
And if you read those papers, it might take you 10 hours.
Yes, that is very true. I did just skim them. But it was an exhilarating experience. And then once you get the keys to your home, if you have a nice broker or agent, they come by and check on you and drop you off a present.
Yeah, that's true. So you must have had a nice agent.
Yes, a very good friend of mine.
Oh, that's good to hear. So some of the things that I'm going to touch on here quickly in a few moments, you've already had the experience of being subjected to this process. Is there anybody else that's purchased a home recently or has gone through this sort of a home buying process? So this is sort of an overwhelming flow chart of how this process works. And if you start up here in the very right-hand corner, if a person had the money to buy the house and didn't need to borrow, they could go directly to a real estate agent and begin that process. But for most people, you're going to start down here at the left side of the screen with having an initial consultation with a loan officer. Did you start with the loan officer first or with your real estate agent first?
With my real estate agent, and she referred me to the broker.
Okay, so so that would be, if you look at this flow chart starting up here, and this is where a lot of people enter the I guess we could call it the funnel or the flow chart, is they do contact an agent, and then they learn, okay, well, you need to go to a bank or you need to go to a mortgage broker or somebody who can initiate a loan. So you start over here at the top on the left-hand corner, and you go all the way through this circuitous path. Um, and eventually you wind up down here at the end of the transaction where the loan is funded and the deed is recorded and you are the owner of the new property and you move in. So this is really a detailed overview, and I'm going to go through each of these separately. So basically, most people are not cash buyers, but if you are an all cash buyer, in other words, you want to buy a house that's worth $300,000 and you have $300,000 or more. Um, you're just going to skip the loan process. You're going to skip the bank altogether and just go directly to a real estate agent, and you're going to begin that process. For most people, that is not the way it works. Um, Most people aren't as desperate looking as this guy, um, who apparently has no money whatsoever. But most home buyers don't have the cash to purchase a home. They have some cash, and so they're going to go to a bank or to a licensed loan originator. Now, in Colorado, um, mortgage loan originators uh, are, don't work for banks. Banks, because they're federal banks, they don't. Their loan officers don't have to be licensed. They just have to be registered so that the national mortgage, licensing system can keep track of them if they move from one bank to another. So uh, the process of becoming, an independent mortgage broker or an independent mortgage loan originator is much more rigorous than what the bank goes through. And bank employees, of course, are doing more than just real estate mortgages. They're doing all kinds of other tasks. So that's how this process is going to begin for the overwhelming majority of people. And so you're going to start with going to find somebody who you probably have been referred to by your real estate agent, or you've seen some promotions about. And you're going to start with an initial consultation in which the loan officer is going to try to learn what it is you want to accomplish. Um, at some point, the borrower is going to complete this secure loan application online and start to fill in a lot of information that is required on the loan application. Now, there are still some old time loan officers who will do this all by hand, um, and start that written document that's called a 1003 loan application. But the majority of people getting mortgages today are going to do this online. And if you were to do a loan through, say, um, Quicken Loans, that company is located in Michigan, and it's all going to be done remotely. And so many of the major lending institutions are that way anymore. So what you're going to do is you're going to begin that application. You're going to upload the required income and asset documentation. Um, that's really one of the first things that the loan officer needs, is to find out, okay, what is your job? How much do you earn? Ideally, you've been in the same job for the past 2 years, and they're going to may want to see your prior 2 years income tax returns and your last two um, pay stubs to show, just exactly how much income you have. And then, of course, you're going to have some money, depending on what kind of a loan you're going to do. If it's a Veterans Administration loan, you don't have to have any money down. if it's an FHA loan, you have to have 3.5% down. So if you were buying $100,000 house, if you could find one, you need $3,500. If you're going to buy a $200,000 house, you need 7,000. So the banking system, the loan officer is going to want to see, bank statements, at least the last 2 months of bank statements, savings account, and of course checking account. And so the loan officer is going to review your application. They're going to run your credit. Credit is one of the big issues in determining what you're going to qualify for, if anything. Credit scores can run from a low of 300 to a high of 850. And there's a lot of misconceptions about, okay, well, how do I establish a good credit score? And so some folks think, well, okay, I'm renting and I've been paying my rent on time. I have a cell phone. I've been paying my cell phone payments on time. And so, that ought to establish that I have some good credit. Unfortunately, the three major credit reporting agencies don't consider those to be trade lines. So you've been making payments on your rent, but nobody is reporting that on-time rent payment to a National Credit Bureau, and so you're not getting any recognition of that ability to pay. Cell phones, same sort of thing. So what they're really looking for is credit cards, perhaps. If you already had a house, well, that would be good because you'd have a history there. Automobile payments maybe where you purchased furniture, not a rent to own type situation, but a regular installment loan. So the loan officer is going to pull the credit, and that's going to tell them a lot. Some loans that a person might want, they'd have to have a 620 credit score. Others, maybe it's a 680. The higher your score, typically the better terms and interest rates you get, and therefore a lower monthly payment. So the loan officer is going to take a look at that and tell the borrowers what they qualify for and provide them with what's called a pre-approval letter that would lay out several lending options. Now, I'll probably tell you this from her experience, but once the loan officer issues a pre-approval letter, that is taken to the real estate agent. And so now the agent knows, well, how much a house can you afford? How much of a loan will you be able to get? And that then makes it possible to narrow the search for a home. Was that your memory of the loan officer providing your real estate agent with some sort of a pre-approval letter that then made it easier to determine what kind of a house you could seek to purchase?
Yes, absolutely.
One of the things we're not going to talk about in much detail here, but owning a home is probably the best way for most people of the 99% of us to actually build wealth is through home ownership. Because, okay, you've got to hopefully have a place to live anyway. You're going to have to make payments. And the question is, are you making mortgage payments on the house that you're buying, or are you making your landlord's mortgage payments by paying the rent? And then the landlord pays their bank, and they wind up with all the equity. Property values can increase, and on average, in the Front Range, they've been increasing like 4% a year. So somebody who bought a $200,000 house at the end of 1 year, that house is probably worth $208,000. Another year, add another 8,000. So over time, it is very possible to build what I like to call generational wealth, meaning wealth that either you pass on to your heirs or you simply use to make more money with. So you begin that home buying process after determining what you can begin, what you can probably afford, and your real estate agent is going to take you to open houses. and you're going to look at houses where maybe there isn't an open house, but it is listed and the real estate agent has access to the house through a system where they have the ability to open up a lockbox and therefore open the property. Did you look at a lot of houses before you were able to buy?
Yes, I did, and it just kind of came across my plate one day, and it was meant to be, I believe,
Mm-hmm.
at the time. So it just worked out perfect.
Yeah. About how many houses do you think you looked at before you found that one?
At least 15, maybe 20 different
Okay.
houses, and they were all very much more expensive than the one I bought.
Okay. So they would have been a stretch in your mind to be able to buy one of them, or um, for whatever reason, things
Yeah,
just worked out.
yeah, it just would have been a little bit, what I had was more comfortable than what I was looking at.
Right. Sometimes, you can qualify for a higher payment and therefore a more expensive house, but it may leave you sort of strapped on making some other payments or doing some other things that you are normally used to doing. So a lot of times it's difficult to see a more expensive house than you can afford and then say, oh, but I'd have an easier time making the payment and I'd have less stress if I bought something a little less expensive. So once you find that house, the home buyer finds the house, they agree to a price and they enter into a contract. And usually you have to put an earnest money deposit down. And that money is often between $2,000 to $5,000. And that, of course, counts toward the purchase price. Uh, but that makes it clear to the seller that, yes, you intend to really go through with this, and therefore they take the property off the market and don't try to sell it to anybody else. And you get a contract that talks about how much time you're going to be given to get the loan process closed. So that money is you usually you hand it to your real estate agent, but the agent puts that in an escrow account, a trust account, at a title insurance company. And then the next step is to have an inspection of the property. Now, inspections are not required, but they're a good idea because that's when you discover what things, if any, are wrong and might need to be fixed. And you might be able to get the seller to fix them. It's a good idea to have an inspection because, if you are on a tight budget and you spend uh, much of your savings to get that house purchased, and then you discover, okay, 6 months later, the water heater goes out and there's a $2,500 charge. The furnace fails in the wintertime, and there's another big charge. So knowing, having somebody who's an expert in home inspection uh, is really, a really good idea. It's not really insurance, although you can buy homeowners, an insurance policy in addition to homeowners insurance that would say, okay, if something breaks down, uh, this, this that kind of insurance would take care of the obligation. Do you recall whether you had any other than just what we call the casualty insurance? It would protect you and the bank if the property burned down or there was a flood.
Yeah, I had a 2-year home warranty, and I used it several times.
Okay,
Major appliances, and it saved me a lot of money.
explain to the class how that home warranty worked.
So the home warranty, anything, major appliances, your water tank, anything that's major appliance, they will come in and fix for a fee. It's usually a deductible $100, and they'll come out as many times as it takes to fix it. And the warranty just comes with the house at the purchase. It's usually either rolled in or given as a part of the package of the deal
Okay.
of the
And,
house.
and so based on your experience, you would clearly recommend that a home buyer have an inspection and purchase a home warranty.
Absolutely. All my appliances were gas powered. So it saved me a lot of money on a dryer that went out a couple of different times. But they fixed it, and it was $100 each claim.
Yeah, and it would have been what to buy if you didn't have that, you would have had to spend what, a couple $1,000s?
Yeah, a couple thousand on a propane dryer. Yeah.
Yeah, great. Thank you. So throughout this process, the loan officer or the bank is going to need to have documentation to back up what the initial um, consultation discovered. So, you're going to have to provide, the bank statements. You're going to provide uh, last 2 months of pay stubs, that kind of thing, so that the loan officer can convince the eventual investor who's going to provide the money that, yes, in fact, what we're saying here is true and accurate. And I don't know whether anybody or very many of you here remember the disaster that happened to the mortgage business and the economy in 2008. But they had loans that were affectionately called liar loans. Liar loans. You tell me that you make $50,000 a year, and you don't have to prove it. You don't have to provide me with a pay stub. You don't have to provide me with your tax statements. You just say, hey, I work in this capacity, and the average income for somebody that's doing that is to make X amount of dollars, and that's what I make. So those were called subprime mortgages, and they turned in to be one of the culprits that caused the collapse of the economy. Because, well, okay, if it turns out that you can't make the payment because you really didn't make what you said you made, now that's going to wind up in the bank having to take the property back and maybe take back thousands of homes. So, for a person who's a mortgage loan originator, an independent broker, what you're going to wind up doing is the loan officer is going to shop different wholesale lenders like United Wholesale Mortgage, Quicken Loans, Caliber. There are dozens of wholesale lenders, and they're the ones that are going to actually provide the money to the to close the loan. And so, what a loan officer does, like what I will do, is to shop, different wholesale lenders to find the best deal, and find what is likely going to make the best loan for my borrower. Banks, on the other hand, they don't have that same flexibility. They already have established this is the kind of loan we're going to do. These are the guidelines. This is what you have to have. And if you don't have that, well, they just you get a denial letter. So I do a lot of brokering to United Wholesale Mortgage. They just went on the walls, on the New York Stock Exchange about a month ago. The young man in the middle took over his father's wholesale mortgage business, when he got out of Michigan State, where he was a basketball player. And his dad's business had 12 employees. In 10 years, they'd grown to 6,000 or maybe 7,000. And so I find them to be a really great, um, mortgage company, mortgage wholesaler, and they only work through brokers. You couldn't directly go to United Wholesale Mortgage, so they cater through, originating loans through loan originators and brokers. So that process of marketing and looking for the best loan is what comes back with the loan officer sitting down with the borrowers and discussing the options and deciding, what's going to work best for the borrower. And once you have made some decisions about what kind of a loan you want, uh, one of the steps that comes next is to lock or freeze the loan interest rate. Loan interest rates change hourly. And recently, I've been seeing them change at least a couple times a day. Um, so when you're going through a broker, at some point you have to decide, well, is this rate good enough, or do I want to hold off and wait for maybe it gets better? And of course, it's kind of like gambling because you don't know whether it's going to get better. But that's a decision that the loan officer and the borrowers make. When do they want to freeze, or as we call it, lock in the interest rate that's going to be the rate that is guaranteed to go along with the eventual loan product? So at that point, you've collected these documents and they go to a processor. And loan processors are very valuable employees in this whole situation because they do a lot of the heavy lifting, a lot of the detailed heavy work. And I think that there are uh, the kind of person who wants to be a paralegal and, and maybe works for a law firm could also work for a law firm that does real estate, and they could become loan processors. So the loan processor is going to order the appraisal. There's going to be some disclosures that have to be made, and they're going to order the title to make sure that there's a clear title to the property. So as I say here in this slide, the loan processor is the workhorse behind the mortgage. And once that processor has gathered everything, they then send that off to an underwriter who is going to review the file and hopefully uh, give a conditional loan approval, which allows the loan to move forward. It's one of the many steps in this process, and so you're going to go to what is called a conditionally approved loan. That then means that, okay, there's some conditions that the underwriter wants to see satisfied, and they give that back to the processor who gets whatever additional documents that the underwriter wants and provides those to the underwriter for final approval. And hopefully, the final approval comes through after the underwriter has reviewed the things that he or she wants to see. And so you get a loan application approved. Doesn't mean it's funded yet because you still have to go through an audit, and they do a re-verification just to make sure that the people are still working, that the borrower is still working. Uh, there will be written verifications of employment, but there also will be calls from the lender directly to the um, employer to make sure that the person is still working. And I've seen loans where the borrower quit their job the day before their loan was to close, and I guess not thinking that the underwriter would be contacting the employer to make sure they still had a job and everything still worked. And they recheck your credit. Credit report is pulled initially, and there are some people who make the mistake then of saying, "Oh wow, I have good credit. I've always wanted a new car," and they'll go out and have their credit pulled half a dozen more times and buy a car. Well, now you've totally messed up the application because your credit score will probably go down because of all those credit pulls, and you now have an additional debt, which will make it maybe more difficult to to qualify for the initial mortgage. So you get the clear to close. That's in my mind when I'm sitting as a loan originator, it's fireworks because that's what we wanted to hear. Clear to close. We've satisfied the underwriter. It's not funded yet, and the borrower doesn't have the keys yet. But this is the big deal. The underwriter is satisfied with all the conditions and every document that the lender needs, and you have a clear to close and you can move forward. So the loan processor is now going to order additional documentation from the title company so that the title company can put together all the paperwork for the signing. And this escrow officer who works at a title company, they prepare these final loan documents for signing, and they calculate the amount of money that the borrowers are going to have to bring to the closing. A little earlier here, it took about 4 hours to sign all the documents. Um, there are a lot of documents because what you don't see in the background is that this loan is probably going to be packaged together with hundreds of other loans, and it's going to be sold into the secondary market, which is like the stock market. So the lender is going to loan, let's say, $10 million. They're going to sell those loans, get $10 million from them, or maybe more, and then they'll be able to make $10 million more loans. And that's how the process uh, works. So the final sort of thing that happens is the happy borrowers come and spend the 4 hours signing the documents. And usually loan officers are going to give you the documents 2 or 3 days in advance so that you actually can read them before you get there and ask questions before you get there. People that are doing a VA loan, Veterans Administration loan, or a US Department of Agriculture loan. So most people are going to bring cash if they have to. If you were dealing with a sophisticated buyer, they might have the money wire transferred from their bank. And so I wanted to toss this slide in here because the way that, let's say United Wholesale Mortgage, if I've got a loan that's about to fund, United Wholesale Mortgage will transfer by wire the $300,000 or $400,000 a few hours before the borrower comes in to sign, so that as soon as all the documents are signed and the title insurance company is satisfied that they've met the requirements, then the title insurance company has that money that just got wired into their account to pay off the seller and to pay whatever the costs there are. So that's how the money often is funded, through wire transfer. And then, of course, as you've probably noticed in some of the documents and some of the chapters you've read, there's a deed that is signed by the seller transferring ownership to the buyer. That is signed by the seller at the closing, and that then gets recorded with the county. And that's when they also give you the keys, because the transaction is complete.